The United States and Iran had agreed to a ceasefire to hopefully come to an agreement to end the war in the Middle East. Well, it looks like that's not happening because just yesterday, JD Vance concluded a 21-hour negotiation with Iran and said that no agreement was made. And then immediately after, President Trump posted this on Truth Social, quote, "Effective immediately, the United States Navy, the finest in the world, will begin the process of blockading any and all ships trying to enter or leave the Strait of Hormuz." After that was posted, we saw stock futures fall and we saw oil futures rise because investors are concerned that this war in the Middle East is going to get worse, it's going to last longer, it's going to have a bigger impact in the economy, and it's going to have a bigger impact on the stock market. So let me break all of this down because the concern that all investors have is that we are going to see a repeat of what happened in the early 1970s, because in the early 1970s, three things happened. Number one, we had a money printing problem. Because in 1971, then President Richard Nixon took the United States dollar off of the gold standard, which allowed the Federal Reserve Bank to print an unlimited amount of money, and that allowed the government to spend a huge sum of money that they didn't have. That created an inflation problem because of the money printing. Then number two was the United States entered a conflict in the Middle East called the Yom Kippur War back around 1973, which caused oil prices to spike. And then these two things led to the third thing, which was high interest rates in order to save the dollar, in order to save inflation, which caused a deep recession and a deep crash in the stock market. Today, we've seen two out of the three things happen. Number one, we saw a money printing problem because of the pandemic in 2020. A lot of money was printed by the Federal Reserve Bank, and then the government spent a lot of money on PPP loans, on unemployment checks, on bailout checks, and a bunch of stimulus in order to help stimulate the economy, but then that led to an inflation problem. Now in 2026, we had the United States enter a conflict in the Middle East, which led to a spike in oil prices. These two things sound very similar to the first two things that we saw happen in the early 1970s. Now the question is, what's going to happen next? Is the Federal Reserve Bank going to raise interest rates in order to fight inflation, or are they going to cut interest rates? But here's where things are very different between now and the early 1970s. In the early 1970s, we did not have almost $40 trillion of national debt. And the reason why that matters is because the fastest growing expense for the United States government is not the military. It's not infrastructure. It is interest payments on our debt. And the United States government has one form of income, tax dollars from taxpayers, which means you are working hard every single day to make money. The government takes a piece of your income in the form of taxes. Well, one of the largest expenses, in fact, the second largest expense out of your tax dollars is just paying back the previous debt interest, which means more and more of your tax dollars are not being used to provide you a service, they're just being used to pay back this debt. Well, this debt that the United States government has is not a 30-year fixed rate mortgage. It is a variable interest rate. And the new thing that's happening today post-pandemic is that the term of the United States government loans are getting shorter and shorter. Back in the 1970s, the United States government had primarily more of 10-year and 30-year loans, which means the interest rate on the United States debt wouldn't change for another 10 or 30 years. Today, we're getting a lot more 1-year loans and 2-year loans, which means the interest rates on our debt are a lot more adjusting. But why does that matter? Because now, if the Federal Reserve Bank is forced to raise interest rates, that means the cost of our debt are going to go up, which means more of your tax dollars are going to have to be used to pay back interest as opposed to actually providing services for you. That's going to put more pressure on the United States government, which could lead to more money printing, which could lead to a bigger inflation problem. I'll explain all of why, but I want to remind you, we've been covering all of this in Market Briefs. Again, Market Briefs is my free financial newsletter for investors, where every day my team is working to break down what's happening in things like the economy, housing, stocks, crypto, and global markets into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning. We have hundreds of thousands of investors that read Market Briefs every morning. And when you sign up for Market Briefs, You're also going to get my free investing masterclass as a bonus to help you raise your knowledge as an investor and find hidden investment opportunities before they hit the headlines. So if you want to get market briefs and my investing masterclass all for free, all you have to do is sign up, and I have the link for you down in the description below. So the United States government has one form of revenue. That's tax dollars from taxpayers. And already the fastest growing expense for the United States government is interest payments. Well, in the 1970s, the United States government had this big inflation problem because we had this money printing and then high oil prices. And the reason why high oil prices make inflation worse is because high oil prices make gas prices more expensive. It makes grocery prices more expensive because your diesel costs are more expensive, your shipping costs are more expensive, your fertilizer costs are more expensive, and your travel costs become more expensive. So high oil prices impact the cost of pretty much everything, which is why they can make inflation worse. Well, how does the Federal Reserve Bank fight inflation? The Federal Reserve Bank fights inflation by doing one of two things. Either number one, they can pull money out of the economy, or number two, they can raise interest rates. Well, in the 1970s, the Federal Reserve Bank raised interest rates aggressively, all the way up to around 20%, which meant if you were getting a mortgage in the late 70s or 80s, now you were not paying 6 or 7% on your mortgage, you were paying 15% a year on your mortgage, 18% a year on your mortgage. And that high interest rate drove the United States economy into a deep recession, and it drove the stock market to a big crash. We saw the Dow Jones fall by almost 50%. Yes, the stock market got cut in half because of those high interest rates. Well, today we have seen oil prices rise. We've already seen the inflation problem. Now the concern is if oil prices stay higher for longer, and they continue to go even higher because of this conflict in the Middle East, that's going to make inflation worse. Now, just so we're on the same page, the reason why the conflict in the Middle East can make oil prices higher is because Iran controls something called the Strait of Hormuz, which is this passageway where a big chunk of global oil passes through. And because of this conflict in the Middle East, Iran can't fight the United States with guns and tanks. But they can fight the United States economically by driving up oil prices. And the way they can do that is by making it more difficult for oil to transport around the world, which means there's a lower supply of oil. And when you have a lower supply of oil, while demand of oil is still up here, that makes the prices of oil go up. And they know that if they want to fight the United States, they will want to raise oil prices to the point that it pushes the United States into a recession. Because those high oil prices make the cost of doing business more expensive, it makes consumption more expensive for the average American, and that can slow the economy down. And so what they're trying to do is fight economically, while the United States is fighting militarily. And so now the question is, if we continue to see higher oil prices, and oil prices go even higher due to this conflict, because if this conflict goes on for longer, oil prices are going to continue going higher, unless something changes. But the way that it is today, oil prices are going to keep moving higher. Higher oil prices are going to impact the prices of everything, including your groceries. And those high oil prices and higher groceries and higher diesel costs will lead to higher inflation. Now, when you have this higher inflation, the Federal Reserve Bank will then have to make a decision. What do? Do you cut interest rates to try to stimulate the economy, but then make the inflation problem worse? Or do you raise interest rates like we did in the past? And now when you raise interest rates, yes, you create a bigger recession, you create a bigger stock market crash, but you save inflation and you save the dollar. And that is the big concern, because in the 1970s, we had something called stagflation. Stagflation was high inflation, slowing economy. It is a very weird concept, because that means on one hand, you have the prices of things going up. On the other hand, you have incomes going down, which is a worst of two worlds situation. And that's why it was such a painful recession, because in order to combat the stagflation, the Federal Reserve Bank had to raise interest rates while the economy was hurting. And now here we are today. We've already seen pain in the economy. We're already seeing pain in the job market because of AI. We're already seeing pain because of higher interest rates. But now the question is, if oil prices stay higher for longer, which Now that this negotiation ended, it looks like the conflict is going to continue on for at least the foreseeable future. The longer it continues, the higher oil prices are going to go, the higher the impact is going to be on the economy. The bigger the oil shock, the more pressure there is going to be on the Federal Reserve Bank to raise interest rates. Now, if interest rates go up, what happens? Borrowing becomes a lot more expensive. People were hoping for cheaper mortgage rates in 2026. They were hoping that they could get lower mortgage rates so they could refinance. Lowe's and Home Depot have been begging the Federal Reserve Bank to cut interest rates. That way people will do a cash out refinance, take that money, go to Home Depot, and get equipment to finish their basement or to build a deck. Well, that won't be happening if interest rates go up. The National Association of Realtors, the Mortgage Bankers Association, have been asking the Federal Reserve Bank to cut interest rates so more people get mortgages, so more people buy houses, to save the realtors, to save the bankers. If interest rates go up, those industries are going to get hurt. Not to mention everything going on with private credit. If you haven't seen my videos with private credit yet, I encourage you to watch them. I will link them for you down in the description. But we have a number of banks on Wall Street that are hurting right now. And the reason why they're hurting is because they were lending money to companies through something called private credit. Now those companies are beginning to default that were borrowing this money. Part of the reason why they're defaulting is because of the higher interest rates, and a lot of banks on Wall Street were hoping the lower interest rates would come soon. That way these businesses could refinance their loans at a lower interest rate, because remember, businesses don't get a 30-year fixed rate mortgage. They get adjustable rate mortgages. And in 2020 to 2022, businesses left and right were borrowing huge sums of money at essentially 0% interest. And now those same loans have readjusted to 5, 6, 7, 8, 9%, which means their cost of business have gone up so much, not because of inflation, but because of higher interest rates. And so you have all of Wall Street begging and hoping for lower interest rates. That way these businesses that were struggling due to the high interest rates could then refinance and pay lower interest rates on the loans as well. Well, if oil prices stay high, the Fed won't be able to cut interest rates, and now that industry gets hurt too. That's why you want to understand this, because higher interest rates have an impact on the economy. Lower interest rates have a different impact on the economy. Now, both create opportunity. I don't say this so people get scared and panic. I say this to understand how the economy works, because our economy is not in a vacuum, that higher interest rates only impact mortgages, or the higher interest rates only impact the treasury market. That's not how it works. It's a domino. Everything impacts everything. If the housing market gets hurt, well then the people that were making money from houses, the realtors, the bankers, the title agent companies, they struggle. When they struggle, they don't have money to go into Chipotle and buy the extra guac, which means Chipotle get hurt. They don't have the money to go into the BMW dealership and buy those BMWs, which means BMW gets hurt. And if BMW gets hurt, that means the BMW dealers also don't have the money to pay their mortgages. So you can start to see how the economy works as an intertwined system. And that's the concern. Because now as oil prices go up, somebody's making money. The oil companies are getting richer. The people that own the oil wells are getting richer. But the people that just sit there on the sidelines, that don't understand, are slowly becoming poorer. Which means, yes, the average American is getting poorer because of this war. Now that's going to sound very weird. But why am I saying that? Well, let's go back to what I've been talking about. Inflation. What is inflation? Now, there's a lot of different definitions of inflation. At the end of the day, when people think of inflation, they think of the prices of things going up. In reality, inflation comes from creating more currency, inflating the currency, which means the value of the dollar is going down. Well, who does inflation hurt? You might say inflation hurts everybody, except that's not true. Inflation hurts some people more than others. The average person gets hurt from inflation. The wealthy and the financially savvy get rich from inflation. Inflation makes asset prices go up. When inflation happens, real estate values go up, stock prices go up, business values go up. But your groceries get more expensive. Your Chipotle gets more expensive. Your coffee gets more expensive. Your car gets more expensive. So inflation means that you have to spend more dollars to buy things. but the investors are getting rich because of that. While at the same time, we've seen incomes don't keep up with inflation. And if you don't believe me, just look at the numbers between 2020 to 2026. We saw inflation at something like 25-26%, while incomes grew by around 22-23%, which means yes, your income probably went up between 2020 to 2026, but the average person's income did not grow fast enough to keep up with the reported inflation. And that's just the reported numbers. The real inflation that many people felt over the last 6 years is a lot more than 26%, because that means that a $100 cart of groceries in 2020 should only cost you $126 today. And I don't know anybody who has only seen their groceries grow by 26%. Not to mention the cost of living, your housing costs, your car costs, it's all gotten a lot more expensive. So on one hand, we have the reported numbers, inflation, which is higher than the reported wage growth. But the real inflation is even higher than that. And now if we go back a number of decades, we'll see that over the last 50 years, the trend hasn't changed. After 1971, when the dollar was taken off the gold standard, money printing skyrocketed, inflation happened. Because now as you print more money, the value of the dollar goes down, causing the prices of things to go up. Now the prices of things go up, which means your groceries get more expensive, your housing gets more expensive, but do you know what doesn't go up fast enough? It's people's incomes. And that's the problem. And that's the concern. That we're already facing a problem of people struggling to afford life because of the post-pandemic inflation. High oil prices are already making gas prices more expensive. We haven't seen the real impact of the oil prices on our groceries yet and everything else that is coming. And now Wall Street, who was hoping, along with everybody else, I mean, nobody wants a war, except some crazy people in those businesses, but not a topic for this video. Nobody wants a war. No sane person wants a war. But the war has impacts beyond just lives too. And I'm not to discredit the people losing their lives. Trust me, that's not what I'm trying to do. What I'm trying to say is economically, because this is a financial channel, there's a lot of costs that people don't understand. There is a financial cost that the average person has to now pick up. And that cost that the average person has to pick up is inflation. And that's the cost that a lot of people are going to start feeling the pain of as oil prices continue to stay high or as they continue to go higher. And that's what you want to pay attention to. Because yes, you can look at it politically. There's a lot of people that talk about the politics. I'm not here to do that. I'm here to talk about the financial side because there's a lot of people already talking about the political side. And what you need to understand is how it's going to impact your wallet. Because the White House is not your house. The White House is not going to take care of your wallet. The White House is not going to take care of your family's finances. Your White House is not going to put money on your table. That's up to you. And that's why you have to understand what's going on and understand how it's going to impact your money. So what does this all mean? It means you need to be an investor, period. Markets are going to go up. Markets are going to go down. If we continue to see more pain due to higher oil prices, the stock market is going to get hurt because of it. We've seen it happen in the past. History doesn't exactly repeat itself, but it does rhyme. So study history, because every time we see oil shocks, the economy gets hurt, the stock market gets hurt. The longer the oil shock, the bigger the oil shock, the bigger the pain. And we don't know how long the conflict is going to last. I mean, there's a chance that this week the conflict turns around and there's a negotiation that happens and it's solved. Great. But until then, you want to understand how volatility can happen. And anytime you see market downturns, the average person panics, the average person freaks out, but also understand that market downturns, market crashes, create more millionaires than any other time. Why? Because they allow the financially savvy to come in and buy good investments at a discounted price. And that's what you want to understand, is that there's always opportunity. There's opportunity when markets are going up. There's opportunity when markets are going down. You just have to know your strategy. And if you are a simple investor, you're not super sophisticated, you don't know how to read a financial statement, I recommend you learn how, but that's not the topic of this video. Let's just say, I don't know what to do. I've never invested in stock before. All you can do is a simple way to start is just invest in the United States economy. Now, I can't recommend what you do. I'm just a random guy on YouTube. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But you can invest in the United States economy. How? Because there are funds out there called ETFs that will give you exposure to the S&P 500. The S&P 500 is a group of the 500 largest companies in the stock market. Well, now, if the economy goes down, the stock market goes down, you can just buy a piece of the S&P 500 when it's down. Because as an investor, you don't really care about what's happening over the next 3 months or even the next 3 years. We're thinking about 5 years down the road, 10 years down the road, 15 years down the road. And if we take a look at history over the last 100 years, we know that recessions happen. In fact, we have seen 16 recessions over the last 100 years. More than one recession a decade. In each one of those recessions, the markets have gone down. How do we know? We've seen 25 market crashes over the last 100 years. And the common denominator amongst each one of those recessions and market crashes is that some people became incredibly wealthy. Why? Because some people were able to come in, buy good investments when they were on sale. And that's what you want to remember. Is that when everybody's panicking, unfortunately, people sell out of their 401ks and retirement accounts. That's not the way you want to be thinking. If you are a long-term investor, use downturns as an opportunity to buy more. Use when markets are up as an opportunity to find unique opportunities. You have to be a little bit more savvy then. But when markets are down, that's when you want to be more aggressive when it comes to buying. That's what you want to remember. Again, Market Briefs is a free resource if you want to stay up to date on what's happening in the markets. I have the link for you down in the description. And if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, family member, colleague, or fellow investor. That way we can continue to spread this type of financial education. And I apologize for the audio in this video. I wasn't anticipating making this video when I've been out of town doing some podcasts in Arizona. I just got back, but I felt like it was very important to make this video. So I appreciate you. Stick with me through this video and I'll see you on YouTube tomorrow.